Same thing.
Well, good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative, here with the Rundown with Rob and Rich, joined as I am every other Friday by Rob Krisman. And as usual, we're starting the conversation with some random, unplanned, non-mortgage industry talk. Before we went live, we had about a 5-minute discussion on Pepperidge Farm Milano cookies, which Rob was furiously scarfing down before we got started here. And they have we're just talking about how they've withstood the test of time. Yeah. So Nerf products and Milano cookies. I guess no matter what changes, they'll stay popular.
It's a when you look at a consumer product like that, whether it's a cookie or a mortgage, the thing is that when you strike a nerve, when you have a successful recipe and you gain a reputation, it's a great thing. It's a very good thing. So anyway,
the 30-year fixed rate mortgage has withstood the test of time, right?
It has here in the United States, unlike most other countries around the world, which don't have 30-year mortgages.
Remember the 40-year fixed rate mortgage craze? It was like 10 or 12 years ago. I think the agencies actually came out with it, and it got little to no. There was very little demand based on what they were expecting, and it just fizzled away, right? If I remember correctly.
It fizzled away, as I recall. Yeah, there wasn't a lot of demand. You have, I'm trying to dust off the cobwebs of my memory, because I believe some countries have a forever mortgage. Maybe someplace like Denmark or Japan or someplace that you just make payments, and when you pay down the principal, you do what you can to pay down the principal, but it just goes and goes and goes. So yeah, you have to I think loan officers oftentimes weigh the or look at alternatives to the standard 30-year and 15-year mortgage packages, or options. You've got ARMs and so forth, or intermediate ARMs, 5, 3 doing 5, 3 doing 10, whatever it might be. But you have to match that with what investors want to see, and investors may not want a forever fixed rate mortgage on their books. They may not want a 30-year mortgage on their books. And I'm often asked, Rich, Rob, why do you always mention the 10-year treasury? Why do you mention the 10-year yield and what it's doing in your commentary? And I have to admit that, as when I talk to MBS traders, they trade as a spread more to the 5-year treasury, sometimes even the 3-year constant maturity treasury, maybe the 7-year, but no 10-year. And the 10-year has become kind of a benchmark. It's easy to discuss. It moves around a lot less, with a lot less volatility than a 30-year bond. And then the tighter maturities, 2-year, 3-year, 5-year, don't move around as much. So the financial press and everybody is kind of settled on the 10-year, but that doesn't mean that MBS traders even look at the 10-year. They're looking at something that more closely matches the duration of a typical mortgage these days, which is, could be 3 years or 5 years, maybe 7 years. Anyway, we digress.
This is the Rundown with Rob and Rich. For all of you just getting logged on here, every other Friday at 3 p.m. Eastern, taking a whirlwind look around the mortgage industry, at all the latest happenings. And Rob, a couple of things you mentioned there that I want to touch on in this episode. Investor demand for U.S. mortgages. Been a lot of talk in our network these last couple of weeks about private label securities making a comeback with some of the pullbacks from Fannie and Freddie, non-owner occupied, and some of the other things that could be coming down the pike from the agencies per the amendment to the Fannie Freddie preferred stock purchase agreement, that is now finally starting to get some mentions in the news, despite the fact it was inked in mid-January. I want to get into all that. And as always, we want to make this show interactive. Please, your questions, comments, jokes, anecdotes, please feel free to drop them in the chat or the Q&A. I already see a bunch of stuff in there. People already wanting more on the UWM Quicken Fairway Battle Royal. comments on Milano cookies, and a note about the HAMP, that the 40-year fixed rate mortgage was used for the HAMP product. That is right, if I remember correctly, right?
Yeah.
The CARP loan that Kevin Pranio and was calling for. That any chance of that? That was his related to the pandemic forbearance. I forget even what the acronym stood for.
Carp,
You
like
remember?
the fish?
Yeah, it made sense. His whole argument for it. It was something related to people coming out of forbearance, and a lot of marketing fun you could have with that as well. But
When back when dinosaurs roamed the earth and I got into this business, one of the jobs of a capital markets person, or secondary marketing was called back then, what didn't have the glorified title of capital markets, was to find investors who would be interested in something other than a Fannie, Freddie, FHA, VA 15-year or 30-year product. And so you would go out, and oftentimes, or I would go out and talk to, retirement plans, mutual funds, whoever basically had the money, local savings institutions, credit unions, and say, what is it that you want if you were going to invest in mortgages and in residential mortgages? What kind of attributes would you like in a pool of loans? And so you were able to structure things like that, like the now fabled CARP loan, apparently, that Kevin mentioned. But you were able to do that, and that kind of thing has died down significantly since 2006, 2008. There's not you don't quite have that amount of flexibility, but you're right. It may come back with the changes that the agencies have made, and of course, it's very easy for the agencies to shrink their footprint because all they have to do is price themselves out of the market, or scale back on a product like they did with second homes and investment homes to set the 7% level, and under the guise of risk management, or let's put an adverse market fee in when there's really no adverse market, or the adverse market, we're all waiting for the adverse market to appear and it doesn't seem to be. And I get a lot of questions about that half point, but the ability for lenders to create new products has been hampered since the financial crisis, and there's some logic there, but with the agency's move with second homes and investment products, there is talk about the private market, the fabled private market coming back into mortgages. But loan officers and everybody on this call need to remember that private money comes with a price. And for example, if Rich, you're a nice guy, I like you, all that, I know you're out there shopping for a home, potentially, and if you go to Fannie Mae or Freddie Mac, they're going to give you a 3 1/8 or 3 1/4, whatever 30-year rates are now. If you came to me because there was some reason that you weren't going to Fannie Mae and Freddie Mac,
1.5%.
No, I know a lot of loan officers who do second mortgages or bridge loans, and it's 10 and 2, man. 10 and 2, 10% and 2 points up front. And that's kind of the going rate. So private money has a cost. So, let's bring in private money. That's not Fannie Mae or Freddie Mac's problem. That is the originator's problem and the borrower's problem in terms of accessing private capital, and private capital wants a return. And we've seen a lot of private capital. I'm kind of going down this tangent here a little bit, but since I'm in a ranting mood today, when companies were going public, the United Wholesale, Rocket, whoever, Guild, Home Point, and so forth, the majority of those companies were going public because the companies that had invested in them, the hedge funds, private equity, and so forth. If you talk to a fund manager or somebody in private equity, they want to double their money overnight. They want to double their money overnight. Anything that takes longer than that, or anything less than doubling, they're not overjoyed with. And so when you talk about private money coming into, and whether that's non-QM some of the non-QM lenders who are rolling out, who are advertising now. We do second homes, we do investment properties, or whoever. They want a return on that money, and they, right or wrong, view that product, second homes or investment properties, as having greater risk than just a standard 30-year fixed rate owner occupied loan. So they want a return. And so, yeah, they could come in, but there's going to be a price. And I think people need to remember that.
Without a doubt, I want to get into this a little bit more. And for our audience, please, we want feel free to chime in with your thoughts as well in the chat or the Q&A on this topic or any other topic on products that have withstood the test of time, like Milano cookies and Nerf products and the 30-year fixed rate mortgage in America. But I think, and we've been talking, some things that we've been talking about for a while that we felt like could come to a head are coming to a head now. One is, the cost of lumber and the impediments to new construction and a burgeoning inventory issue in America. The other is the pullback of the agencies. And so to just, recap what has happened here on January 15th, Mark Calabria and FHFA amended the Fannie Mae and Freddie Mac preferred stock purchase agreement document, essentially saying we're not going to privatize Fannie and Freddie, but in an effort to prep them to be released from government conservatorship, want these steps to be followed. So the 7% cap of any loan sold by a lender to the agent, and I think it's just Fannie that has said something to this point, but the Freddie, it's coming any day now. That was in there directly. So that was the first domino to fall. No more than 7% of loan sales can be non-owner investment properties or second homes. The next line in there is no more than 3% of purchase loans sold to the agencies, or 6% of purchase or 3% of refinance can have two of these three characteristics: either below 680 FICO, over 90 LTV, CLTV, or over 45% back end ratio. So that's 678, 95 or 92 or 93% loan. That's not a horrible deal. Those can now not represent, not yet, but expecting that's the next domino to fall here, cannot represent essentially more than 3-4% of your total loan sales to Fannie and Freddie. And it's just now starting to make news. NAR had been all over it from the get-go. I think MBA kind of adopted we're just glad they're not taking them out of conservatorship approach initially. And now I think they're starting to get some pushback from their members. And Housing Wire ran a piece yesterday where MBA penned a letter expressing and there's other things too. Caps on lenders can sell the agencies a max of, I think, $1.5 billion in any rolling 12-month period to the cash window, and some other things too. Have you heard anything from your readers on this?
The A, no. B, this is why people watch the show every other week, because of the information that you just gave out. There are future caps. It wasn't as if all of a sudden we had a taper tantrum. The Federal Reserve starts tapering off their asset purchases and the market reacts and we have a taper tantrum. The FHFA, the Treasury, they have pretty much told us what's going to happen, what they want to have happen. And, pick your reason for why they would tell us or why it's going to happen, whether it's their risk profile, whether Mark Calabria just wants to shrink their footprint in general, whether they want to shift more product to non-QM investors or FHA, which is not exactly probable, but they're shrinking their footprint, or they're at least changing their footprint. And they have given the market, as you just detailed, their thoughts on what's going to happen. One of the big things, Rich, when you ask about the emails that I receive, it's more about the implementation. The good news is it impacts everybody in the industry. The bad news is, how are we going to implement this? How is Fannie Mae or Freddie Mac going to track this. And so how from a day-to-day loan officer, capital markets person's perspective, how are they supposed to monitor these things? Or is Fannie Mae is it going to give them a warning? Is Fannie Mae just going to call them up on a Tuesday morning and say, hey, no more non-owner or second loans this year or this month? Or I mean, there's a lot of confusion about that, and I'm sure the agencies are spending their time with that. But the gauntlet has been thrown down, or the warning shot has been fired. It's in there. The question is, how will it be implemented? And frankly, Mark Calabria has never ever been a friend of Fannie Mae and Freddie Mac. It was an interesting appointment made by the Trump administration to put, it's like putting an oil lobbyist in charge of the EPA, something like that. So to put Mark Calabria in charge of two entities that he's not a big fan of is a very interesting strategy, and we're seeing that now. I would expect that at some point the Biden administration will somehow look for a replacement, in which case some of these things may be repealed, but I wouldn't hold my breath. But for now, I think originators are really focused on closing the loans that they have in their pipelines that were locked in January and February and early March. They're trying to get those funded on time without extension costs or renegotiations or whatever it might be. And then they'll kind of take a breath and take a look at it come the early summer. But for right now, everybody's just kind of focused on funding their pipeline and trying to make some hay while the sun shines. They haven't considered this too much. I'm sure they will. They'll have to, right?
Yeah, and right now, as I understand it, Biden can't fire Calabria, that there's a case with the Supreme Court. It's expected to have a ruling June, July, from what I've heard, that could change that. But even if it does change that, even if he does fire Calabria and bring someone else to head FHFA, it would be surprising to undo steps that are putting the agencies on a path to exit conservatorship, although it does fly in the face of really the hallmark of his housing plan really was affordable housing, first-time home buyers, first-time home buyer tax credit, and
home ownership.
And these changes, they impact most that first-time home buyer and, people kind of on the periphery that want to,
Yeah. Now to your point, you bring up a very good point there. Second homes and non-owner occupied homes aren't exactly in the charter of Fannie Mae and Freddie Mac to promote home ownership. Those programs typically are used by more affluent people, typically not first-time home buyers. You're typically not buying a rental house before you buy your home. And so the argument could be, well, this is really impacting a minority or the minority of borrowers, and they tend to be affluent, or do they really need to buy another rental house and get a loan from Fannie Mae or Freddie Mac? The answer is probably no. But it'll be interesting to see what happens with Director Calabria's position in the Supreme Court ruling in the early part of the summer, and where we go from here. Which coincides with, roughly, as I said, a lot of these locked pipelines as they fund and are sold into the secondary markets, in April and May and June that are locked now. It'll be interesting to see what the pipelines are replaced with. There's the purchase business has been interesting to watch. We were talking before the show began about some of the inventory issues, or the inventory issues everywhere. I know that earlier in the week, you had Eric Roman on the show. I believe that you brought up the topic of the fact that there are now more realtors than there are home listings in the United States. So that's very telling. But yeah, Fannie Mae and Freddie Mac, they continue to evolve. Every week they're making announcements, they're doing some things, and they have regulators and politicians on one shoulder and lenders and consumers on the other shoulder. It's a tough tough place to be for Fannie Mae and Freddie Mac and Mark Calabria. So, the continuing saga continues.
Yeah, it's going to be interesting to see how it all plays out. I mean, they're, massive cash registers for the federal government. You talked about the half point. Your joke in your email, in your newsletter this morning was funny. Still waiting for that adverse market. I mean, outside of forbearance, there's really no delinquency. There's a crazy demand for housing. Where is this adverse market that they're zacking half a point on all refis for? And then just embedded into the cash pricing of any lender that sells to the agencies is a lot of embedded inflated guarantee fee that goes to the federal government directly as well. I mean, I've talked about it before on this show. I remember being a cap markets guy and negotiating at one point, I think like a 16 and a half or 17 basis point guarantee fee when you could do that with the agencies. Now, from the smart people I talk to that can crack cash pricing, they're saying everybody's got a G fee in the mid 50s. So roughly embedded into their Fannie and Freddie cash pricing. So that's 38 basis points in rate. And we know what that equates to in price in every loan, separate from the adverse market fee, separate from loan level delivery fee, separate from all that. And right now it's fine because the Fed is buying the living shit out of the bond market and keeping rates low. So it's hard to argue too much about it but what happens when 30-year fixed rates are 4.25 and 4.5? It's hard to undo those things, right?
Yeah. I remember what Tracy King Donadio said a few weeks ago on the borrower side about credit. The more good news, the borrower's credit in general tends it's looking pretty good right now. You have a lot of people out there. The savings rate is above 20%. They haven't been spending a lot of money. Their credit card balances are down. The credit reports are strong. So that's some good news. That's creating a lot of competition for these houses. But you're right. When rates go up, and we all knew at some point they would, right? The pressure is for rates to go higher because of the stimulus packages and because you can just feel. I'm not a horse guy, but I can imagine, like, if you were riding a horse and that horse was straining and just wanting to go and wanting to run faster, which would terrify me, but you can feel that horse, feel it. The economy is kind of like that right now. There's a lot of pent up demand. I want to go to a conference and shake hands with you and have some cheap Chardonnay before the end of the year, maybe even this summer. I want to go travel. I want to go into a bar or restaurant. I want to see my friends. I want to go buy a new necktie or whatever it is, pair of socks or something. And a lot of consumers have been sidelined, but their credit is very, very good. To Tracy's point from a while back from Partners Credit. So the economy wants to move forward. And that typically drives up rates. And so if we get to the point where 30-year fixed rates are in the fours, then I think Fannie Mae and Freddie Mac are going to have issues with their guarantee fees. They're going to have issues with the adverse market fee because maybe there was never an adverse market. And especially when you're constricting second homes and non-owner occupied loans, because of their risk profile, well, you are lowering your exposure to an adverse market. So why not give us back that half a point? And so, but the problem is, and I've used this analogy on this show and try not to yawn while I use it, but if you're in a little community and they decide to build a bridge and they're going to charge $1 toll to cross that bridge. Okay. Yeah. And when the bridge is paid for, they'll eliminate that toll. Well, you know what? They'll never eliminate that toll, even after the bridge is paid for, because the politicians and the government in general are not going to rail against the government or politicians, but they're used to that income. They like having that income. Fannie Mae, Freddie Mac. Oh, they need to be recapitalized. Well, looking at their current revenue, it'll take decades to get them to the point of really being recapitalized. But nonetheless, the government likes the income that they're bringing in. Fannie Mae and Freddie Mac obviously like the income that they're bringing in. I don't see them removing the adverse market fee ever. I think they'll just get used to it. I think they'll keep G fees where they are. And fortunately, the G fees, you were talking about, negotiating a G fee. Fortunately, the G fees, for the most part, as far as I know, are pretty uniform across every lender. So that's good news. So it's not like they're singling out Rich and Rob's mortgage and giving us a 50 basis point G fee. And Ryan and Sarah's mortgage up the street, they only have a 30 basis point G fee. There's not that discrepancy like there used to be. So that's a little bit of good news, but it's quite a juggling act that Fannie Mae and Freddie Mac have to go through with regard to risk and return and pricing, market share, and so forth. There's a lot going on there.
Yeah, and that is part of the Fannie Freddie PSPA amendment, that they maintain that equality on G fee from lender to lender, to not, play favorites or allow people to negotiate that down and to give advantages to the larger lenders. I encourage everybody. It is a public document. If you just Google Fannie Freddie PSPA January 15th, it is a public document you can read. You can see the blueprint of what is likely coming, with the agencies. And again, surprised it hasn't generated more discussion, but I think it will now. So this is the rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, here with Rob Chrisman, and a lot of notes have piled up in the chat here.
And Rich, I need to interject. I need to pat, and I don't often do this, as you probably may have noticed, but I need to pat the Mortgage Collaborative on the back, because you guys had some big news break today. You want to spend a minute or two telling the viewers about that?
Yeah. You know me, I'm not the self-promoter, but we started an emerging technology fund for our members back in November. Essentially, our members can, it's a fund, it's a pledge fund. So it's not like, with your 401k, where you put money into a mutual fund and you have a manager that's making investments for you. It's a pledge fund. So you have the ability to invest in opportunities that you want to, and you don't have to invest in individual opportunities you don't. So it was structured cool. And we launched it in November. It's taken off. I didn't, because things were so busy. I didn't know, how quickly it was going to get out of the gates, but it's been great. So we have a group of about 18 members that have been really active with it, assessing we're getting a lot of new looks on emerging technology options, or like our first investment with Maxwell. This is, they've been a partner at TMC for 3 or 4 years now. It's an established point of sale company that is raising money to expand what they're doing. And our members liked it and decided to collectively invest in it. And we've got a couple more investments that we're going to be announcing in the weeks to come. But it's a pretty cool thing that we're doing. And it's kind of like a benefit of membership that, you're not going to find on our website or anything, but always trying to keep our finger on the pulse of ways we can create value creatively in non-traditional ways. So
Very neat. Very neat.
So getting back to the chat, Joe Lindow, my buddy here in Cleveland, reminds me that the 40-year, anything over a 30-year fixed was deemed as non-QM as part of the whole QM thing. So
yeah, I thought so, but I wasn't sure enough to blurt that out.
Mm-hmm. We have, did you know NERF stands for non-expanding recreational foam? I never knew that. I never knew what NERF stood for. For those that are lost, we were talking about products that withstand the test of time.
I was gonna say, Rich, what chat room are you in, man?
Yeah. And then we have a call for us to demand government justification of the adverse market fee. Since they are accountable, it's the federal government, but I think it would just be too easy for them to say, delinquencies are still 6%, even though it's a forbearance inflated number, and right, and that, there's, I don't think it would be tough to get anybody from the government to provide an accounting of the adverse market fee, right?
Yeah, I don't, I don't, I mean, I wish I could snap my fingers and have that happen. Um, Really, fortunately, if you think back 10 or 12, 14 years, the huge tidal wave of foreclosures that a lot of experts were suggesting was going to happen did not happen. A, because investors bought properties. B, because borrowers were able to uh, 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 make their payments. Or C, you had big corporations come in and buy up homes, buy up inventory of REOs from banks and so forth. So the tidal wave of foreclosures to really push values down a long way never really happened. When forbearance was initially introduced through the CARES Act, a lot of the quote experts said, "Oh my gosh, there's going to be a tidal wave of delinquencies and foreclosures when forbearance rolls off." Now, granted, forbearance has continued to be extended, but I think that the stimulus packages, and I think that just the market itself, the economy, is to the point where we may cross that bridge to where forbearances begin to roll off, and we don't see a tidal wave of anything, because the demand is so strong out there. So you're right. I don't see the adverse market, and I'm sure if we had somebody on the call with us today from Fannie Mae or Freddie Mac, they could argue against that. But personally, I don't see the adverse market that they have been that they talked about. So
This is
yeah,
the rundown with Rob and Rich. We've got about 10, 12 minutes left here, and we got to touch on the Rocket UWM fairway just because it's so amusing to me. But before we go there, I kind of opened the show today, at least the mortgage part of it after the Milano cookie talk, about the private label security market. So we've had a lot of members come to us like, hey, can TMC, or is there because essentially what's happening is, I think it was Redfin that put out a report in the last week that just non-owner occupied investment property transactions are up like 81% year over year, right? All the people that made money on GameStop and are getting stimulus money that don't need it, they're evidently buying investment properties. So then we've had on the other end, the agencies put the clamp down on non-owner. So what we're hearing is that there's more demand for investment property financing. There's less options right now to sell it to the agencies, and not a lot of other alternatives out there because all the aggregators are kind of falling in line. And so can private label securities fill this void? So for the lay person, Rob, explain what a private label security is, and is there, you think, any chance of some private entity providing some kind of solution for what seems to be like a mismatch between demand for investment properties and a clamp on the financing piece of it?
sure. It's a very broad stroke when you say private label securities. And when people ask, like, what is a private label security? The easiest thing to think about is, or the easiest way to explain it, it's not entirely accurate, but it's pretty close, is to say anything that's not backed by the US government. FHA, VA going into Ginnie Mae securities. Ginnie Mae securities have an explicit government guarantee. Now, granted, if something goes wrong with a loan, the servicer has to pony up some money until the government steps in and makes them whole. But those loans, those securities, Ginnie Mae securities, are backed by the US government. Fannie Mae and Freddie Mac have an implicit government guarantee, so that if something really goes to hell in the handbasket, it is thought that the government will step in and help. Everything else, when you look at jumbo loans, when you look at non-QM loans, some of the armed securities that are out there, almost anything else is what I would term a private label security. It is Morgan Stanley issuing a residential mortgage-backed security, Goldman Sachs. It is Wells Fargo issuing a residential mortgage-backed security that Wells Fargo says, well, we have enough jumbo loans, so let's issue a jumbo or a security backed by jumbo mortgages. That is in effect a private label security. So it's a big bucket that different things fit into. But basically, the easiest way to think about it or explain it to somebody is a security not backed by government-backed loans.
So let's think about this. So, so Fannie and Freddie cap sales of investment properties and second homes, 7% per lender. Lenders that I've had co-host the last week in Mortgage Today, I'm trying to pick all their brains on it. Most have told me they immediately examined their pipeline and there was a little bit more than 7% in there. And they had to make some adjustments. But, I've talked to other lenders where they had 18, 19%. So they're really scrambling now. They've priced these loans out from a guideline and price perspective to the agencies. They're now having to go to the aggregators that are adding fees, anticipating this, right? Not wanting to get adversely selected with this was going to Fannie or Freddie and, just get hammered with investment property loans. So even with those increased fees, so let's just say for argument's sake that, aggregator A, puts an arbitrary, 2.5 point hit on all investment property loans. Like the private, do you think even if somebody, a private label security issuer were to come out and maybe just try to buy investment properties at like cherry pick the market, essentially, like 70% or below, 750 and over, I could see that happening, right?
Absolutely. At some point, and the thing that you've learned when you're really in capital markets or you're trying to sell a car or trying to sell, Tom Brady rookie card, it's supply and demand. And at some price, somebody will buy an asset. At some risk profile, some price, somebody will step in and buy, that purple Ford Pinto that's been in your garage for, 30 years. Somebody will buy that Tom Brady rookie card for $1.3 million. Somebody will buy Michael Jordan's $15 million mansion. At some price, somebody will buy it. The question is, though, at what price? And you're right, you're spot on. When Fannie Mae and Freddie Mac, or say Fannie Mae, came out with that announcement about 7%, and hey, here's what was laid out some months ago, it's no surprise, and here's what we're doing about it. The immediate reaction within a day or two from Chase and Wells and Citi and all PennyMac and AmeriHome, their fees shot up by 2, 3, 4, 5 points, because that is the quickest way to turn off the spigot in terms of a product coming through their doors, because they didn't want to get stuck with it. And there's some pretty smart guys and gals in those companies in terms of capital markets and saying, okay, if private money, if AmeriHome, for example, I'm just singling out AmeriHome, I'm just using them as an example. AmeriHome says, all right, we're going to get a bunch of non-owner and second home mortgages in here. And you're right, they could be 30, 40, 50% LTV cherry loans, great loans. But if we have to issue our own security, if we have to go to the rating agencies, Standard & Poor's, Fitch and Moody's, and we have to use an investment bank and pay investment banker fees, and we are going to create a security for second homes or non-owner occupied homes, this is going to be the hit that we expect to see out there. Whether it's 3 points or 5 points bid back of where normal Fannie Mae and Freddie Mac first lien mortgages are trading. So that's the best and brightest said, okay, we don't have a price hit. We expect a price hit if we potentially have to go to the market and create a private label security backed by, Mr. Cooper. Mr. Cooper goes to market and creates a security and says, okay, here's a bunch of non-owner occupied loans, and the weighted average loan to value is only, 58%. And the credit score is this, and give the attributes of the pool, they're thinking it's going to trade back of regular Fannie Mae and Freddie Mac loans because those loans are not backed by Fannie Mae and Freddie Mac. They may have used DU or LP to underwrite them, and they may have used the same other guidelines in terms of appraisals and appraisal waivers and so forth. But they are viewing these loans as having a hit, and that's why within a day or two of Fannie's announcement that so many companies jumped in and jacked the price up.
Yeah, we got a couple really nice, insightful comments in the chat. One is, this already exists. Bayview has been buying non-owner occupied for private label for months. They just got a pot of gold dropped in their lap. So another member of the audience chimed in and said, a large aggregator we spoke to confirmed what Rob said about private label securities. They expect to issue as much as 4 to 5 billion in investment property second home private labels in 2021 due to the 7% cap. So it sounds like that there's already some market participants that are lined up and
Yeah.
ready.
I think it's fascinating. I know we're running out of time here a little bit, but there's so many things that are going on right now in mortgage banking that are very, very interesting. One of which is the borrowers out there, the consumers. Yeah, we're coming off a pandemic. We're hopefully toward the tail end of this pandemic, but so many individuals have been saving money. And when you talk about a K-shaped recovery and some portion of the borrowers are doing very well and others are not, a lot of the borrowers or a lot of people out there, their savings rates are very high, and they've been saving a fair chunk of change here in 2020, and they are ready to put it at work. And whether they are ready to put it to work in buying a first, owner occupied, their first time home buyer loan, or you have investors who, they've been saving money too, and they have cash, and they could very well say, I mean, they may have an option to say, all right, I can take this cash that's earning, a quarter or a 0.5%, and I can just buy a rental house cash, outbid my competitors and buy it with cash, and not care about Fannie Mae or Freddie Mac's rule, or not care about Penny Mac or AmeriHome's, price hit. I'm just going to buy it with cash. And so that'll be interesting to see how, if that market shifts toward away from financing for second homes and non-owner homes toward people just paying, using the cash that they've saved up during 2020.
We're just about out of time, but we got to hit on the UWM Rocket Fairway thing. I know you were texting me when HBO was on CNBC the other day. I did end up seeing a tape of it, and it was the typical, like, I don't care if my competitors don't like me, visit getamortgagebroker.com, visit getamortgagebroker.com, and very competitive guy, and he's pedal to the metal. We'll note this share price is like in the sevens, though. It is really not generating a lot of demand in the investor community. So any thoughts on that?
Yeah, I looked after Matt said, we're different because we're going to keep paying a dividend, and I looked at my smartphone because that's the source of all my knowledge. And if you look at UWM, you could buy the stock, and the dividend yield is nearly 4.9%, which is a good dividend yield. The question is, of course, are they going to keep paying that? And that's Matt's point, is that the market doesn't understand us. We're different than others. You just start talking about purchase versus refi, and here's our focus, and here's what we've been able to do, and we're going to keep paying this dividend. It'll be interesting. I don't know. You and I didn't talk about this, but at least on the West Coast, right after Matt's TV event, up popped a Rocket ad with like Tracy Morgan, I think, looking at his phone, talking about Rocket. I don't know if you noticed that, but I just burst out laughing. I said, well, Matt, now we've got a Rocket ad. Anyway, fun times.
That's going to be interesting to watch too. He's betting on essentially broker market share, for his company to succeed as a stock company. Mortgage broker market share has got to go to a place it's never been before in this country, to 16-17% currently, to about 25%. And it'll be interesting to see how it all plays out. So, Rob, any parting thoughts for the audience on a Friday afternoon here?
Don't deny yourself the pleasure. Life's short. You're not going to be on your deathbed saying, you don't want to be on your deathbed saying, I wish I ate that extra Milano cookie for lunch.
God, those are
That's
such
about
great
it.
cookies, honestly. Yeah, it's universally loved. So, like Rob Chrisman. So,
Yeah,
with that,
right.
this was another episode of the Rundown. Really appreciate everybody that took some time out this Friday afternoon, and we'll be back 2 weeks from today, every other Friday at 3 p.m. And really lucky to have some great sponsors lined up. Vice Capital Markets, near and dear to my heart. I think their third client ever back in my cap markets days, and Equilibrium Solutions, who has been a great solution for our members as an outsourcing provider, especially this last year. They helped so many of our members out, helping manage really intense volume. And just a note too, talking about conferences, TMC Summer 2021, Terranea, just outside Los Angeles.
Lots of cheap Chardonnay will be flowing.
Lots of, I don't know how, it might be cheap, it's like $8 in the store, but $40 a glass at Terranea, real cost to TMC. But yeah, there will be lots of things flowing for sure. September 19 to 21, and we've already opened registration, and we're off to a great start. We're expecting a huge, hopefully, we're maybe too big a crowd depending on what's going on with the pandemic, but we'll figure that out later. I guess good problems to have. But other than that, that's all I have. As always, we'll upload this to our YouTube channel and make a podcast out of it, so you can also find this program there as well. And Rob, I'm sure I'll talk to you before then, but I'll see you on this show 2 weeks from today. So have a great weekend.
Thank you very much, Rich. Take care.